Welcome to the Deep Dive. Today, we're digging into NRG Energy's third quarter 2025 results, looking at their earnings call and the strategy decks they put out. We've got a fair bit to unpack here.
Yeah, definitely. Our goal today is really to pull out the key takeaways for you. We're looking beyond just the numbers. It's about how NRG is setting itself up for, well, a future with much higher power demand. Think data centers. Plus, they've got this huge acquisition cooking.
Right, and the big headline jumping out is just validation, really.
Yeah.
Strong operations, record results. They actually hit their highest quarterly adjusted EBITDA ever.
Yeah.
And they stuck to their raised 2025 guidance. That's between, what, $3.875 and $4.025 billion.
Exactly. Hitting a record high like that, it says a lot about their execution. In Q3 specifically, adjusted EPS was $2.78. That's up like 32% from last year.
Yeah.
So yeah, we need to look at what's driving that kind of growth.
Okay, let's unpack that Q3 performance then. The total adjusted EBITDA, $1.205 billion, a 14% jump year over year. Where's that coming from mainly?
Well, two big things stand out. First, Texas. It's just consistently their powerhouse. Year to date, their adjusted EPS is already $7.17. That's a 36% increase compared to last year.
And in Q3 alone, Texas brought in $807 million in adjusted EBITDA. That's a 38% improvement. What struck me is that this wasn't just because of some crazy hot summer in Texas, which, can happen.
That's a really key point. The materials emphasize it was commercial execution, better margins, smart supply optimization. They pulled this off even with the relatively mild summer in ERCOT. It shows their model works reliably. It's not just riding the volatility wave.
Okay, now let's talk about the part that maybe raised some eyebrows initially. The Vivint smart home deal, a big power generator buying a smart home company. How's that fitting in now? Why is it suddenly looking like a success?
It's all about the platform, really. Vivint isn't just selling security systems anymore. It's becoming this key piece for managing the grid. So in Q3, Vivint added a solid $272 million in adjusted EBITDA, and crucially, they hit record highs for keeping customers and signing up new ones.
Retention is key in that kind of business.
Absolutely. Their customer base grew 9% year over year. That's way ahead of the 5–6% they had planned for. So keep customers happy, add new ones, and fold them into this residential virtual power plant, or VPP, initiative. That's where the synergy is. They're turning homes into flexible grid assets.
VPPs are definitely a huge part of the future, turning demand into controllable supply. Okay, so Texas and Vivint are strong. We should probably just quickly mention the areas that saw some declines.
Yeah, good point, for balance. The East segment was down a bit, mostly due to higher retail supply costs, tougher competition outside Texas. And the West Service other bucket was impacted by things we knew were coming, selling the Airtron business last year and a lease ending at the Cottonwood plant.
So expected adjustments, really.
Pretty much. Minor compared to the strength in Texas and what they're building with the smart home platform. They seem to be managing those legacy transitions okay.
All right, so that strong cash flow, especially from Texas and Vivint, gives them the firepower for their big strategic push, data centers. The growth there is pretty stunning. Total contracted capacity jumped, 51% just since Q2?
It's incredible acceleration. They're now at 445 megawatts contracted across ERCOT in Texas and PJM, the Eastern Grid. And the latest deal is really interesting. 150 megawatts, premium long-term contracts for sites in Maryland and Illinois, so that's PJM territory.
And that PJM deal, it doesn't even start delivering power until 2028.
Yeah.
And won't be fully ramped until late 2032. That really shows the long game they're playing, locking in capacity years out.
And locking it in at higher prices. This is maybe the most fascinating bit. Because demand is so strong and forward power prices are up, NRG is now saying their minimum target for these new long-term data center deals is above $80 per megawatt hour. They're pushing the floor up from that $70–$90 range they talked about before.
Above $80 is a floor. Wow. Why now? Is it just NRG flexing, or does it say something bigger about the whole market?
I think it signals systemic tightness, honestly. It's not just NRG being opportunistic. It reflects how valuable, firm, reliable power actually is, especially in grids like ERCOT and PJM, where building new stuff quickly is, well, difficult. To make these huge long-term build-outs work financially, they need those high-margin contracts.
Yeah.
$80 is basically saying the era of cheap power for massive users is kind of over.
And they're backing this up with a huge pipeline of future projects, right? Through partnerships with GE Vernova and Kiewat.
Yeah, the pipeline of potential deals, joint development agreements, letters of intent that grew 35% just this past quarter. It's now at 5.4 gigawatts through 2032.
5.4 gigawatts. That's enormous.
It is.
Yeah.
And it ties into a couple of big trends. First, this idea of bring your own generation, or BYOP.
Okay, let's quickly explain BYOP for listeners maybe not steeped in power contracts.
Sure. Basically, instead of just buying power off the grid, the big user, like a data center company, works directly with the generator, like NRG, to build or secure dedicated power sources, often nearby. NRG wants to be the go-to partner for these deals.
Got it. And the second trend, you mentioned policy.
Right. Policymakers are laser-focused on grid reliability and this concept called additionality.
Additionality, what does that mean in practice?
It means if you want to connect a massive new load, like a giant data center, you need to ensure there's new generation capacity being built to serve it. You can't just suck up existing power and make the grid less reliable or more expensive for everyone else. So by planning 5.4 gigawatts of new projects, NRG is basically telling regulators, hey, we're bringing the new supply to meet this new demand.
That's a smart move, aligning with policy like that.
Yeah.
And speaking of capacity, we can't forget the VPPs. They're aiming for 7 gigawatts total VPP capacity now.
Yep, that includes the big chunk, 6 gigawatts of commercial and industrial VPP coming with the LS Power deal, plus their own residential VPP goal, which is 150 megawatts now, aiming for a gigawatt by 2035. That flexible distributed capacity is really valuable.
Okay, so that 6 GW VPP brings us neatly to the LS Power acquisition. That's still on track for Q1 2026.
Firmly on track, yes. That's the message. Adding 13 gigawatts of gas generation and that 6 GW VPP portfolio is obviously a massive integration task.
Huge. Where's the risk there? And how important was getting the financing right?
Well, the main risk is always operational integration, keeping everything running smoothly. But they de-risked it significantly on the finance side. They managed to lock in the debt financing on really good terms, about 90 basis points, better than they initially thought.
90 basis points. In this interest rate environment, that's a serious win. What does that translate to?
It means saving tens of millions in interest payments over the years, makes the deal look better financially right off the bat, improves the return profile, and it gives them a much bigger footprint, especially in competitive markets like PJM.
And beyond buying assets, they're building too using that Texas Energy Fund, the TIF program.
Yeah, this is a big structural plus for them in Texas. They finalized the loan for the 689 megawatt Cedar Bayou plant. And the key thing, it's a 3% low-interest loan from the state. Getting capital at 3% right now is, well,
Game changer.
pretty much. Other developers might be paying double or triple that for capital. It makes NRG's new Texas plants incredibly cost competitive. They've basically got a state-backed cost advantage.
And they've got another project, T.H. Wharton, moving along too. So altogether, about 1.5 gigawatts coming online from TATE between mid-2026 and mid-2028.
That's the plan. So you add it all up to the LS Power deal, the TF builds, the VPPs. They're adding something like 15 gigawatts of gas capacity and 7 gigawatts of VPP capacity over the next few years. It's a massive build-out.
Okay, with all that happening, they gave some early guidance for 2026, but stressed it's standalone, right, before LS Power is factored in.
Correct. The 2026 adjusted EBITDA midpoint target is $4.05 billion. That's about $200 million higher than the 2025 midpoint, mostly driven by assets they already acquired, like Rockland, and importantly, a higher assumed power price in Texas. They bumped their assumption from $47 up to $53 per megawatt hour.
That $6 increase just on the Texas price assumption says a lot about how tight they expect that market to be, even without layering on all the future data center deals.
It really does. And maybe the strongest indicator of their confidence in the core business. They reiterated that 14% EPS growth target, compounded annually through 2029. And it specifically said that 14% excludes any upside from data centers.
So the base business, Texas, Vivint, existing assets, is already set for strong growth. Data centers are potentially just gravy on top.
That seems to be the message. Which brings us to how they're rewarding shareholders.
Right, capital allocation. They're sticking to the plan for 2025, returning at least $1.3 billion via buybacks and dividends. But they also announced new plans.
Yeah, the board approved a new $3 billion share buyback program running through 2028. And they intend to use $1 billion of that just in 2026. That signals pretty strong conviction from management that the stock is undervalued.
And dividends are growing too.
Yep, an 8% increase approved for the annual dividend, bringing it to $1.90 per share. That lines up perfectly with their long-term 7-9% dividend growth target. Consistent story there.
And underpinning all this, they sorted out the financing for LS Power back in October, right? A big $4.9 billion debt deal. Yeah.
Exactly. Locked in the funding needed for the cash part of the acquisition and refinanced some other debt. So they're heading into the 2026 close with their liquidity in good shape.
Okay, so let's try and synthesize all this. What's the core story for you listening to this deep dive?
I think this story is really about scale and strategic positioning.
Yeah.
NRG is showing they can execute really well operationally, especially in Texas, and now with the smart home piece. They're using that strength to make some aggressive, forward-looking bets on where power demand is heading, data centers being the prime example. And they're building or buying massive amounts of capacity to meet it. The LS Power deal, the T-Team projects, the VPPs. They're really transforming into a national energy player focused on capacity.
And that transformation brings us back to that tension we talked about, the demand side pull, especially from industry, versus the cost for everyone else. We heard Texas demand is up almost 30% in 5 years. We heard data centers are pushing contract prices over $80 a megawatt hour.
Right. The market's tight, policies demanding additionality.
So here's the final thought for you to chew on. As big players like NRG lock in these high-priced contracts for huge industrial users and get subsidized financing like that 3% EF loan to build the needed generation, what does this ultimately mean for electricity affordability for the average home? Are we heading towards a future where the cost burden shifts more heavily onto residential customers because the industrial load is securing its supply differently? That feels like the big question hanging over this whole shift.
A really crucial question. It's likely to be a major focus for regulators and policymakers going forward.
Definitely something to watch. Thanks for joining us for the deep dive. We'll be back soon to unpack the next set of source materials.